Good day, ladies and gentlemen, and I would appreciate it greatly if you could click on the subscribe button or the bell icon down below, because it's very important to me that I have new subscribers on my YouTube channel. Now today we're going to be discussing financial charts, and as recently as the 1980s, brokers and traders charted the movement of assets by hand. And when I first started out trading in the 1970s, we would sit there with our graph paper and watch a ticker tape, and we would be putting our own dots on the charts. Of course, the markets were a lot slower. We didn't have computers, and we didn't have instant feed, and we didn't have online trading. And charting was a slow, complicated process, time-consuming process, not complicated, time-consuming. But in 4 decades, the world has changed. We have Java charts, we have HTML charts, we have financial charts that will let you do everything and anything these days, easily with no programming on your own. They'll let you drop on all kinds of indicators, all kinds of oscillators, all kinds of technical analysis. They'll even highlight news events for you. They'll spot candlestick patterns for you on your candlesticks. It's virtually endless what today's charts can do for you. And this is what's put us on an even keel with professional traders, banks, hedge funds, because we're using the same technology they are. So retail investors can now compete successfully in this arena. Now, charting software allows those in any market to see price moves, observe changes over various stretches of time, and combine this information to conduct market analysis and predictions. Now, I'm going to stop and make a general information statement because it's very important, because most new traders don't think about it. Most experienced traders don't think about it. But your charts are only as accurate as the feeds coming to your charts. Now, most cases, I would advise everybody to use the charting services on the broker's platform, because he's got the fastest feeds possible, because he's feeding the feeds into his whole system, because he's got to do buy and sells and and execute trades. When you're using free charting services, now nobody's trying to bamboozle you, but when you're using free charting services, a lot of them will tell you there's a 5-second delay, a 10-second, a 1-minute delay, a 5-minute delay, because the feeds, the data feeds, are way, way, way more expensive when the faster they are. So free charting service, and they have the disclosures, can't afford to pay for those super fast feeds. And then feeds coming from like exotic places are even more expensive. So please keep this in mind. Always be aware of how fast the feeds are. Like, you can go, and I use TradingView, but I have a professional package with TradingView. When you have the free package, they tell you. A lot of times you go to assets and you won't even see the updated asset, or they'll tell you can only get it in 15-minute or 1-hour increments. So please be aware, your charts are only as good as the data being fed into them. And it's absolutely necessary to carry out intelligent trades. Without it, trading currencies or trading anything would be more like gambling. So expect to spend a lot of time reading trading charts. And once you put in the work, you will be able to fluently interpret the information on the screen. So think of learning to chart with starting with your ABCs. First, remember back when you were a kid, you learned the ABCs, and C was for cat, and cat was for, rhyme with hat, and hat rhyme with bat. And after a while, you could string together these ABCs and spell words, and then you could string together these words and make sentences, and then eventually you could actually put them together and write a novel. But you can't start out without the basics, and you need to get through the basics to get to the next step. So many newbie traders ask which chart setup is the best. They want to jump all the way through, and they want to see a financial chart that they don't even understand what they're looking at. And they want me to tell them, use RSI, use MACD with a 6, 12, 9 and do this news. And when you see something, trade. Or they want me to tell them, you know what? Use a multi-moving average setup and use a 30, 60, 90 and make your trades. Well, that's not what it's all about. So there are different types of charts used in technical analysis of the CFD market, the cryptocurrency market, or stock market, of ETFs, bonds, whatever you're looking at. Some of the most common ones include line charts, bar charts, and candlestick charts. Now, there are many esoteric type charts out there. And we're not going to get into those because those are for very unique, odd trading circumstances. The general ones are line chart, bar chart, and candlestick chart. So let's go over the main three types of charts. Line chart. I virtually never look at a line chart. I don't have a problem with a line chart, except the line chart doesn't give you any information at all. In reality, a line chart will connect or put a dot on your chart it'll connect a high to a high or a close to close, whichever you're looking up. But on standard, a line chart uses the close of each period and then draws a line connecting them together. So you get some general viewpoint, but nothing that we can use to make any type of analysis. So line charts, you can see a general trend, but that's about it because it's a simple line drawn on your charts. Bar charts were for many years the favorites of the marketplace. I use bar charts for years and I still use bar charts. I'm a bar chart trader. A bar chart starts out by putting a dot on the chart at the open of the trading period. So if you're looking at a 1 hour chart, beginning of that hour, you'll put a dot and you put what I call a doohickey, a line to the left. That's going to signal the open, where the price opened of that asset at that period. There's a 1 hour chart, it's beginning of the 1 hour. It's a 15-minute chart, it's the beginning of each 15 minutes. Then you put a dot at the highest price it reached during that period, a dot at the low, and a doohickey to the opposite direction at the close. So it kind of looks like a ladder. So if you stepped up the ladder in the period, that was a bullish period. If you stepped down the ladder, it was a bearish period. And therefore, with a bar chart, we can start to see, now this is the same chart you saw with the line chart, but now you can start to see commonality. You can start to see what price is doing, because now we see the opens, the highs, the lows, and the closes. We see prices that were important on this journey, and we can see how big each time period, the swing of the time periods. We can see the relationship from one time period to the next. Candlesticks use the same information. Believe me, the only information we have available to us is the open, the high, the low, and the close, as well as volume. Otherwise, there's no other information. So candlesticks use the same pieces of information, and they put the same dots on to draw the candlestick. The main difference lies in how candlestick charts display the open and closing price. And the candlesticks, instead of looking like a ladder, like a bar chart, look like a candlestick. So in this case, at the open, we put a line across. At the close, we put a line across. We put a dot at the highest price and a dot at the lowest price. And we connect the open and to the close to form a body of a candle. The upper line from the body to the high and the low are called wicks. Now, if we stepped up from the open to the close, that's a bullish candle. If we stepped down from the open to the close, that's a bearish candle. Now, in today's world, we use red and green candles as a whole. But they were originally black and white candles. Black because in the old days when we were charting by hand and we were just using pencils and graph paper, If it was a bullish session, we would just, we would be drawing by hand the body of the candle. And if it was a bearish session, we would take the side of our pencil and just color in that candle. So we would have a black candle. And then the bullish candle, we just would leave empty or hollow, and we would call that a white candle. Now, the reason this is important to know is, number one, you could use pink and purple. You could do orange and chartreuse, as long as you knew which was indicating bullish and which was indicating bearish. But a lot of information you'll learn about candlesticks will refer to black and white candles, and some of the patterns are called 3 black crows and 3 white soldiers. And that's because the names were given to them a long time ago, before we had all this modern technology. But we can see a lot of difference between this chart and a bar chart. Now, unfortunately, too many novice traders just see this chart, don't know really how to read it, and see lots of reds and greens, and start making trading decisions on the abundance of reds and greens. Now, candlestick charts are the most popular of all 3 major chart forms, and as such, they are the type you will see most often when you trade. So why do traders love candlesticks so much? Well, candlestick charts are highly informative. It is not only the information every chart element contains, but also regularly repeated patterns that help traders to see oncoming market changes. These patterns help to see the short-term direction and prediction of the bullish and bearish trend. Just one element, a candlestick, is able to reflect many parameters, such as the market's open, high, low, and close, and then in respect to the previous candles. The color of the body indicates the result of the close. The shadows, long or short, show the high and the low prices within that same time frame. The structure of all trade charts is pretty much the same. They are based on 2 axes, the horizontal and the y-axis. Now, candlesticks are easy to interpret and are a good place for beginners to start figuring out Forex chart analysis. Candlesticks are easy to use. Your eyes adapt almost immediately to the information in the bar notation. Plus, research shows that visuals help with studying, so it might help with trading as well. Candlesticks and candlestick patterns have cool names such as shooting stars, which helps you to remember what the patterns mean. And candlesticks are good at identifying market turning points, reversals from an uptrend to a downtrend, or a downtrend to an uptrend. Now, there are a total of about 72 candlestick patterns, which are the patterns that come about based on the current candle, the previous candle, and sometimes a third candle before. And some are called shooting stars. We have bullish haramis, bearish haramis, we have hanging man, we have marabuzos, we have dojis. Well, candlestick pattern recognition doesn't really help us in our type of trading. And it's slow and difficult to memorize all of these patterns. And when you do pattern recognition, you are told, when you see this pattern, do this, do that, and this is what should happen. Well, that also locks you into making prejudicial decisions as opposed to thinking. Now, there are some patterns that help us because they appear often, like bullish engulfing and bearish engulfing. They're very reliable patterns, but not reading and memorizing the definition of what you're supposed to do. Okay. It's recognizing and being able to understand what you think price is about to do. So you need to understand that bar charts also have patterns. Most traders focus on candlesticks and forget about bar charts. But again, both of them use the open, the high, the low, and the close. The direction that price has moved during the bar is indicated by the location of the opening and closing feet on a bar chart. But see, in bar charts, we have bullish patterns, bearish patterns. We have higher highs and higher lows, there are patterns we can see. So where we have with bar chart patterns, and this is why bar charts were so successful for so many years, it doesn't give you hardcore definitions or fancy names. We can see an exhaustion bar. We can see a Pinocchio bar because it looks like it's lying. We can see a 3-bar reversal. We can see a quiet 3-bar reversal. Okay. And these are around for a very long time. But everybody seems like candlesticks. They're colored, they're pretty to look at, and they work extremely well. But it takes a bit of practice, whether you're reading a bar chart or a candlestick chart. But now that we kind of know what charts we have to start to use these charts. Because ultimately, the only thing that's important to any trader is price action. And price action is the movement of a securities price plotted over time. Price action forms the basis for all technical analysis of a stock, a commodity, or any asset chart. Many short-term traders rely exclusively on price action and the formation and the trends extrapolated from them to make trading decisions. Technical analysis is a practice, is a derivative of price action since it uses past prices in calculating that can be used to make informed trading decisions. Now remember, technical analysis is a very broad field. Many of us get stuck on technical indicators, which is only a small section of the field or the science or the art of technical analysis. And indicators are there to indicate. They are the interpreters of the market. Price action is ultimately what's all important. Price action analysis is the act of studying and reading and interpreting the price movement of a market over time, which involves the use of raw price charts to trade the market with no indicators. By learning to read the price action of a market, we can determine a market's directional bias as well as trade from reoccurring price action patterns and price action setups that reflect changes or continuations in the market sentiment. In simpler terms, price action analysis is the use of the natural or raw price movement of a market to analyze and trade it. This means you are making all of your trading decisions based purely on the price bars or the candlesticks on a naked or indicator-free price chart. All economic variables create price movement, which can be easily seen on a market's price chart. Whether an economic variable is filtered down through a human trader or a computer trader, the movement that it creates in the market will be easily visible on a price chart. Therefore, instead of trying to analyze a million economic variables each day, that is impossible, you can simply learn to trade from price action analysis, because this style of trading allows you to easily analyze and make use of all market variables by simply reading and trading off the price action created by those market variables in a price chart. Price action trading generally refers to the up and down movement of a securities price when plotted over time. Different looks can be applied to a chart to make trends in price action more obvious to traders. Technical analysis formations and chart patterns are derived from price action. Technical analysis tools like moving averages are calculated from price action and projected into the future to inform traders. Price action can be seen and interpreted using charts that plot price over time. Traders use different chart compositions to improve their ability to spot and interpret trends, breakouts, and reversals. Many traders use candlestick charts since they help better visualize price movement by displaying the open, the high, the low, and the close in a context of up and down sessions. Candlestick patterns such as harami cross engulfing patterns, and 3 white soldiers are examples of visually interpreted patterns. The typical price action chart with candlesticks and a bar chart at the bottom show volume. Volume is very, very important. But we can use all types of patterns and information to interpret price action. But you're using the price on your chart and the movement on your charts to interpret what price is trying to tell you. Now, of course, the time period used also has a huge influence on what traders see in a stock or an asset. And then we can apply tools such as indicators, oscillators, chart patterns to then move us to high probability trades. But ultimately, we need price and price action signals to make trading decisions, because price action is the only thing that never lies to you. So keep it simple. Read your price charts, be able to understand what price is telling you, and you want to pay attention to your swing highs and swing lows. You want to pay attention to your support and resistance levels. You want to pay attention if you want to wave analysis of price action. Trend lines should always be on your charts. And lastly, moving averages can help you take the noise and the clutter out of the markets. But summing up, price action trading is a trading methodology that uses the movement of price as inputs for making trading decisions. It allows you to tell a story of what the price is doing and make a higher probability trades based on that story. It is a form of technical analysis. As we mentioned, price action trading revolves around only using price on the security to make an informed decision. But it doesn't mean that we can't look at other ways